Do you hear that? That silence? That is the sound of a market holding its breath. Right now, as I speak, silver is balanced at $65.77. It isn't collapsing. It isn't exploding. It is hovering, suspended in a narrow band of tension. To the casual observer, this looks dull. They glance at the chart and shrug. Nothing's happening. The excitement is over. But to the trained eye, this silence is deafening. This is not boredom. This is pressure. This is two armies staring across a battlefield waiting for the signal to charge. We are approaching the most critical moment of the week, the weekly close. For 5 days, the banks have tried to break this market. They raised margins. They dumped shorts. They attempted to drag silver back to $60, and they failed. Look at the screen, $65.77. We are still standing on the high ground. The refusal to fall is the most bullish signal I have seen in decades. This Saturday's close is not routine. It is historic. It is the verdict on the week's war. And the verdict is about to be written in green. Why does Friday matter? Why does it matter if we close at $65 or $64? Isn't it just a number? No. In institutional finance, the daily price is noise. Hedge funds don't care about Tuesday mornings. They care about the weekly candle. The weekly close is the verdict. It tells us who won the war for the week. Did the bulls push higher, or did the bears drag it down? For 3 years, every time silver tried to break out, the banks used Friday afternoon to smash it. They would dump paper contracts right before the bell, forcing the candle to close with a long wick on top. That wick signaled weakness. It scared away technical traders. It worked, until now. Look at today. We are trading at $65.77, near the highs of the week. If we close here, the weekly candle will be a solid green bar. No wick, no hesitation. In Japanese charting, this is called a Marubozu candle. It means buyers were in control from open to close. It sends a signal to every algorithm on Wall Street. The breakout is real, the selling pressure is exhausted, and the trend is alive. Most importantly, it triggers the machines. Billions of dollars managed by trend-following systems are programmed with a simple rule. If an asset closes the week above resistance, buy at Monday's open. Resistance was $65. We are above it. If we hold this line for a few more hours, the robots will execute their orders. That is why the banks are terrified. They know the machines are watching. They know that if they fail to smash the price before the bell, they will be overrun by algorithmic buying next week. So this silence you see at $65.77 is not boredom. It is the calm before the algorithmic storm. Look at the chart. Silver shot from $60 to $66 in a straight line. That kind of move is unsustainable. Normally, after such a rally, the price crashes back to check the foundation. But silver didn't crash. It stopped. It went sideways. It is trading in a tight range between $65.50 and $66. In technical analysis, this is called a bull flag. Picture a flagpole shooting straight up. That's the rally. Now picture the flag itself, fluttering at the top. That's the consolidation. This is the healthiest pattern in the world. It means profit takers are selling, but new buyers are stepping in instantly to absorb them. I'll sell at $66. Fine, I'll buy at $65.80. The exchange happens seamlessly. The price doesn't drop. This is absorption. Buyers are absorbing sellers without letting the market fall. Think of it like holding a beach ball underwater. The banks are pushing down, but the pressure of the water, the buyers, is pushing up. Right now, the forces are equal. That is why the price is flat at $65.77. But the banks are tiring. Their arms are shaking. And the moment they let go, the beach ball won't rise gently. It will rocket out of the water. This bull flag is the market recharging. It is building the base for the next move to $70. So don't be bored by the flat price. Be excited. Boredom is where fortunes are made. This silence is the coil before the spring. There is a psychological dimension to this level. For a generation of investors, $65 was a fantasy. It was the moon. People said, if silver ever hits $65, I'm selling everything. Well, here we are, $65.77. And guess what? People aren't selling. A few traders took profits, yes, but the mass exodus never came. The stackers are holding. The ETF investors are holding. Why? Because they realize $65 isn't the top. They look at inflation. They look at debt. They look at the Samsung battery headlines. And they realize $65 is just the beginning. This is a psychological victory. The banks were counting on retail panic. They thought that if silver touched $65, the sheep would dump their holdings. But the sheep didn't dump. The sheep became wolves. We have realized the value of what we hold. We are not looking for an exit at 65. We are looking for an entrance at 100. This change in psychology is what creates supercycles. When high prices done T cure high prices, when high prices create more demand, that is when markets go vertical. And I want to remind you of what didn't happen today. It is Friday. Historically, Friday morning is smash time. The jobs report comes out. The dollar rallies. Silver crashes. We've seen this script 100 times. We were ready for it today. We were ready for silver to drop to $64, but it didn't. The smash failed. The dog didn't bark. Why? Because the physical market is too tight. Dealers are short of inventory. Refiners are halted. If the banks try to smash the paper price to $64, industrial buyers step in and say, "Thank you for the discount." The banks have lost their power to crash the market. They can stall it, they can make it go sideways, but they can no longer drive it down because every dip worsens the shortage. That creates a floor, a concrete floor at $65. We are walking on that floor right now, and it feels solid, so the market is strong. The weekly close is critical. But what happens when the clock hits 5 p.m. and the market shuts for the weekend? The closing bell is approaching, and the silence on the tape is louder than any crash. Silver is holding at $65.77, and the banks know what that means. They know the verdict is about to be written in green ink across the weekly chart. They know the algorithms are watching. And they know that if they fail to drag the price back below $65 before the bell, they will face a tidal wave of machine-driven buying on Monday morning. This is why Friday matters. In modern finance, the daily noise is irrelevant. The weekly close is the verdict. It is the candle that funds and algorithms use to decide whether to commit billions. For years, the banks relied on Friday smashes to distort that verdict. They would dump contracts in the final hours, forcing the candle to close with a long wick, signaling weakness. But today, the wick is gone. Today, the candle is solid. Today, the verdict is strength. If we close at $65.77, the weekly candle will be a Marubozu, a bar with no wick, pure conviction from open to close. That is the signal the algorithms are programmed to obey. Trend-following systems, CTAs, managed futures funds, they all run on the same logic. If price closes above resistance on a weekly time frame, buy. Resistance was $65. We are above it. The logic gate flips from wait to execute. Billions of dollars are tied to that switch. And when it flips, the machines don't hesitate. They don't negotiate. They buy. This is why the banks are terrified. They know the robots are watching. They know that if they fail to smash the price in the next few hours, they will be overrun by algorithmic artillery next week. This silence at $65.77 is not boredom. It is the calm before the storm. Let's talk about the pattern forming on the chart. Silver shot from $60 to $66 in a straight line. That kind of move usually burns out. Normally, the market crashes back to check the foundation, but silver didn't crash. It stopped. It went sideways. It is trading in a tight band between $65.50 and $66. This is a bull flag. The rally is the pull. The consolidation is the flag. It is the healthiest pattern in technical analysis. It means profit takers are selling, but new buyers are absorbing them instantly. I'll sell at $66. Fine, I'll buy at $65.80. The exchange happens seamlessly. The price doesn't drop. This is absorption. Buyers are absorbing sellers without letting the market fall. Think of it like a beach ball held underwater. The banks are pushing down, but the pressure of the water, the buyers, is pushing up. Right now, the forces are equal. That is why the price is flat at $65.77. But the banks are tiring. Their arms are shaking. And the moment they let go, the ball rockets out of the water. This bull flag is the market recharging. It is building the base for the next move to $70. There's a psychological dimension to this level. For decades, $65 was a fantasy. Investors said, if silver ever hits $65, I'm selling everything. Well, here we are, $65.17, and they aren't selling. A few traders took profits, yes, but the mass exodus never came. The stackers are holding, the ETF investors are holding. Why? Because they realize $65 isn't the top. They look at inflation. They look at debt. They look at the Samsung battery headlines. And they realize $65 is just the beginning. This is a psychological victory. The banks were counting on panic. They thought if silver touched $65, retail would dump. But retail didn't dump. Retail held. The sheep became wolves. We are not looking for an exit at 65. We are looking for an entrance at 100. That change in psychology is what creates super cycles. When high prices done a T cure high prices, when high prices create more demand, that is when markets go vertical. And remember what didn't happen today. It is Friday. Historically, Friday morning is smash time. The jobs report comes out. The dollar rallies. Silver crashes. We've seen this script 100 times. We were ready for it today. We were ready for silver to drop to $64, but it didn't. The smash failed. The dog didn't bark. Why? Because the physical market is too tight. Dealers are short of inventory. Refiners are halted. If the banks try to smash the paper price to $64, industrial buyers step in and say, "Thank you for the discount." The banks have lost their power to crash the market. They can stall it. They can make it go sideways, but they can no longer drive it down because every dip worsens the shortage. That creates a floor, a concrete floor, it's at 65. We are walking on that floor right now, and it feels solid, so the market is strong. The weekly close is critical. But what happens when the clock hits 5 p.m. and the market shuts for the weekend? The bell hasn't rung yet, but the machines are already watching. In modern finance, humans are no longer the majority. 80% of the volume is algorithmic. Black box systems, CTAs, managed futures funds, they control hundreds of billions. And right now, every one of them is staring at the same number, $65 for weeks. They've been cautious, waiting for confirmation. But if the weekly candle closes above resistance, the logic gate flips. The code changes from wait to execute. And when code executes, it doesn't hesitate. It doesn't ask why. It buys. This is why the banks are desperate. They know the robots are watching. They know that if silver closes above $65, Monday morning will bring a tidal wave of automatic buying. Buying that has nothing to do with headlines, nothing to do with fundamentals, everything to do with code. This is the algorithm switch. It is cold. It is unfeeling. It is a mathematical inevitability. Think about what happens over the weekend. These funds rebalance their models. They calculate position sizing. They prepare allocations. And on Sunday night or Monday morning, they execute market buy orders to fill those allocations. That is why Mondays after breakouts are explosive. It is the sound of heavy artillery arriving. Retail bought the rumor. Industry bought the dip. Now the machines buy the trend. And machine buying is relentless. It doesn't care if the price rises 10 cents or $10. It has a target allocation, and it will keep buying until it hits it. So if you're thinking about selling here, remember, you are selling into the mouth of a machine that has just been turned on. Now let's talk about the weekend. Usually, traders hate weekends. They hate holding positions when markets are closed. They fear gap risk. They fear waking up to bad news and lower open. But in a bull market, especially in a currency crisis, bull market, the risk flips. The risk isn't holding silver. The risk is holding dollars. Think about the geopolitical landscape. Think about banking instability. Think about export bans. These things don't stop happening because the New York Stock Exchange rings a bell. If news breaks on Saturday, a mine strike, a new inflation number, a government announcement, you can't buy silver. The shop is closed. You're stuck with fiat until Sunday night. And when the market opens, it doesn't open where it closed. It gaps. It might open at 60 cents or $60, $80. If you're holding cash, you just lost purchasing power while you slept. You cannot get back in at the old price. This is why smart money doesn't sell on Friday. They don't want to be naked cash over the weekend. The safety trade is silver. The risky trade is the dollar. That is a paradigm shift. And look at the media. For years, Bloomberg, CNBC, and the Wall Street Journal ignored silver or mocked it. They called it a pet rock. They called us crazy. But look at the headlines this week. Silver outperforms gold. Solar demand squeezes supply. Is silver the new lithium? The narrative is pivoting. Why does this matter? Because the media controls the herd. The average investor doesn't read mining reports. They buy what television tells them is hot. When mainstream media validates silver, it gives permission to the public to enter. It tells advisors it's safe to allocate. It tells pension funds that silver is legitimate. That is the wall of money. The whale is big. The robots are bigger. But the public is the biggest. They are late. They are always late. But when they arrive, they bring the mania. They don't care about $65. They only care that it's going up. And when the herd arrives, valuations go irrational. We are seeing the first signs of that awakening now. Articles are being written. Segments are being filmed. Next week, the retail investor who ignored you for 5 years may call asking how to buy a coin. That is a lagging indicator of price, but a leading indicator of mania. We are moving from smart money to public participation. And public participation is where prices go vertical. Now consider the options market. We talked about gamma squeezes, but there is another concept, max pain. Every Friday, options expire. Market makers want the price to close where the most options expire worthless. Usually they pin it in the middle, but today they lost control. There are thousands of calls at $65 now in the money. That means banks owe metal to option holders. They have to deliver. If we close at $65.77, banks go into the weekend with short inventory. They cannot hedge over the weekend. They have to sit and pray that no bad news breaks. That creates anxiety in boardrooms. It means Monday morning, the first thing they must do is cover. They must buy back the exposure they couldn't hedge on Saturday. The Friday close acts like a slingshot. The higher we close, the more in the money calls exist, and the more forced buying we see on Monday. It is mathematical certainty. The derivative market is dictating the physical price. And right now, derivatives are screaming buy, so the robots are triggered. The weekend risk is high, the media is pivoting, the banks are trapped. But where exactly are we going? If $65 is the floor, where's the ceiling? The weekly candle is forming, the verdict is almost sealed, and the battlefield is shifting from human hands to machine logic. But before the bell rings, let's step back and look at the larger map. Where exactly are we going? $65 is the floor. What is the ceiling? The answer lies not in headlines or rumors, but in geometry, in the mathematics of charts, in the patterns that markets carve across decades. Pull up the monthly chart, zoom out, forget the 5-minute candles, forget the daily noise, look at the sweep of history. In 1980, silver peaked at $50. Then came a 30-year bear market, a long rounded bottom. In 2011, silver hit $50 again. That created a giant cup, a bowl-shaped formation that took 3 decades to build. From 2011 to 2024, the market drifted downward, forming the handle. Consolidation, weak hands shaken out. And now we are breaking out of that handle. This is the cup and handle pattern. In technical analysis, the bigger the base, the higher in space. A pattern that takes 45 years to build does not resolve with a $2 move. It resolves with a measured move. Calculate the target. The depth of the cup runs from the bottom, around $4 in 2001, to the rim at $50. That is a $46 range. Add that range to the breakout point, $50 plus towards 46 or 96 scars. That is the technical target. $96 an ounce. Not hype, not speculation, geometry, market behavior. We are at $65. We are barely a third of the way through the measured move. The breakout above $50 was the starting gun. Everything happening now, the surge to $60, the pause, the move to $65 is confirmation that the pattern is active. We are in the early innings. Now zoom in, look at the intermediate targets. Traders use Fibonacci extensions, ratios found in nature, in galaxies, in seashells, in human psychology. Markets move in these ratios. The most important is the golden ratio, 1.618. Measure the move from the $20 low to the $30 breakout. Project upward. The golden ratio extension lands around $72. That is why $65 is just a rest stop. The algorithms we talked about earlier are programmed to target these Fibonacci levels. They buy the breakout and set profit orders at the next extension. The roadmap is clear. We are clearing the $65 zone. Once it is established as support, the magnetic pull shifts to $72. Between $65 and $72, there is little price memory. Price hasn't spent much time there historically. That means low friction. We could move from $65 to $72 faster than we move from $20 to $30. The air is thinner up here. The moves are bigger. So if you see silver jump to $68, $69, $70 next week, don't be surprised. It is simply the market filling the vacuum up to the golden ratio. But beware of a common mistake. Novice traders look at the RSI, Relative Strength Index. It measures momentum. When RSI goes above 70, textbooks say overbought, sell. Right now, silver's daily RSI is high. It is flashing overbought. Novices are selling. They think it must crash. But here's the secret. In a strong bull market, overbought is not weakness. It is a strength. Assets can stay overbought for months. Look at Bitcoin in 2017. Look at Nvidia in 2024. They hit overbought and then doubled. And doubled again. Why? Because buying pressure was so intense, the indicator pinned to the top, it stopped working as a sell signal and became a velocity signal. If you sell silver just because RSI is high, you are bringing a knife to a gunfight. You are betting against a freight train because the speedometer says it is going fast. Yes, it is going fast. That is the point. Look at the weekly RSI. That is the more powerful signal. In 1980, weekly RSI hit 95. In 2011, it hit 90. Right now, we are in the 70s. There is room to run before true euphoria. Do not let the overbought label scare you out of a generational trend. Markets stay irrational longer than shorts can stay solvent. There's another factor, round numbers. Humans love zeros and fives. We like $65. We like $70. We love $100. These numbers act like magnets. When the price approaches them, it gets sucked in. We just conquered $65. The next magnet is $70. Why $70? Because it is a psychological milestone. It feels expensive. Sellers will line up there. I'll sell at $70. But in a shortage, round numbers become fuel stations. Price hits $70. Sellers sell. Buyers absorb. Price pauses. Then gaps through. We saw it at 30. We saw it at 50. We just saw it at 65. We will see it at 70. So the charts are bullish. The Fibonacci targets are higher. The cup and handle is active. But charts don't pay bills. Execution does. How do you handle the next 48 hours? How do you handle the emotions of holding a winning trade over the weekend? The closing bell is ringing in New York. The week is over. The bankers are retreating to their weekend estates. The algorithms are shutting down, and silver is standing tall at $65. Take a moment. Breathe. Do you realize what just happened? The banks threw everything they had at this market. They tried to smash it on Saturday morning. They failed. They tried to trigger a sell-off at lunch. They failed. They tried to pin the weekly candle with a wick. They failed. The market absorbed every blow and stayed standing. This week will be remembered. We broke the $65 wall. We triggered the gamma squeeze. We forced the shorts to cover. And now we enter the most dangerous time for an investor, the weekend. For the next 48 hours, the markets are closed. You cannot buy. You cannot sell. You're left alone with your thoughts, alone with the headlines, alone with the noise. And this is where mistakes are made. In this final chapter, I want to give you the weekend protocol. I want to teach you the hardest skill in finance, the art of doing nothing. Because right now, doing nothing is the most profitable action you can take. There's a story about Jesse Livermore, the greatest trader of the 1920s. He made millions during the crash. One day, a young trader asked him, "How did you make so much money? Did you trade the breakouts? Did you short the dips?" Livermore looked at him and said, "It was never my thinking that made the big money for me. It was always my sitting." Sitting. It sounds easy. It is the hardest thing in the world. Right now, you are sitting on a massive profit or a massive position. Your brain wants to act. It wants to lock in the win. It wants to hedge the risk. It wants to tinker. But the Livermore Rule says, if the trade is working, don't touch it. Don't prune a flowering tree. Don't cut the rope holding your parachute. Sit. This weekend, you will see headlines, geopolitical rumors, scary articles about interest rates. Analysts are warning of bubbles. Your brain will whisper, maybe I should sell half on Monday morning. Maybe I should buy a put option. That is the enemy. In a supercycle, the big money is made by identifying the trend and then sitting until the trend breaks. Has the trend broken? No, we just closed at a weekly high. Has the shortage ended? No. Refineries are still halted. Dealers are still short. So why would you act? The Livermore Rule says, if the trade is working, sit. You need to understand the weekend media cycle. Financial networks need viewers. But markets are closed. There is no price action to report. So they manufacture fear. They will find a guest to say silver is in a bubble. They will find an analyst to say $65 is a double top. They will spin narratives to keep you glued to the screen. You must ignore them. Remember, the people on TV are not holding physical silver. They are paid in fiat to read a teleprompter. They do not understand shortages. They do not understand industrial desperation. If you let their noise into your head, you will wake up on Monday anxious. You will look at pre-market at 4 a.m. searching for a reason to sell. And the moment there is a tiny dip, you will hit the button. Then 2 hours later, silver will rip to $70 without you. That is how they steal your position. They use the weekend to plant doubt. Your defense is simple. Turn it off. Do not check the news. Do not check the forums. Go outside. Spend time with your family. The price will be there on Monday. Staring at it on Sunday does not change it, but we must be prepared for Sunday night. Because of the strength of this close, because we held 65 minus 77, the probability of a gap up is high. When Asian markets open, they will see this candle. They will see that U.S. banks failed to smash the price. That signals weakness in the West. The East may attack. We could see silver open at $66, $50, or even $67 Sunday night. If that happens, do not chase with leverage. Gaps often fill. Price may jump, then pull back to $66 to test the floor. If you want to buy more, wait for the retest. But if you are already holding, smile. A gap up is the market telling you supply is so tight that the price must teleport higher to find a seller. On the flip side, if bad news breaks and we gap down to $64, do not panic sell. Remember the bear trap. A Sunday gap down is often bought up by Monday lunch. Stick to the plan. Stick to the trend. Conviction is the final weapon. For years, silver investors lived on hope. We hoped manipulation would end. We hoped industrial demand would kick in. We hoped the dollar would weaken. This week, hope died. It was replaced by certainty. We don't have to hope anymore. We saw the banks fail to crash the price. We saw the Samsung battery tech confirmed. We saw the $65 wall crumble. We are no longer speculating on a theory. We are living a reality. The deficit is real. The shortage is real. The price action is real. This shift in mindset is critical. When you operate from hope, you are fragile. When you operate from certainty, you are unshakable. You are holding the most undervalued asset in modern finance at the precise moment it is being repriced by a desperate world. You do not need to hope. You just need to wait. So here is the verdict. The bulls won the week. It wasn't easy. It was a dogfight. But we closed above the line. The technicals point to $72. The fundamentals point to $100. The psychology is shifting from fear to FOMO. Next week, The battle will move to $70. It will be volatile. It will be loud. But you are ready. You have the map. You have the armor. Enjoy your weekend. You earned it. The closing bell has rung. And for the first time in 45 years, it sounds like victory.